So I've been doing a lot of those earnings review videos because it's been a pretty volatile earnings season to a lot of stocks. We have stocks like Chipotle down over 10% in just one day. I mean, it's been pretty brutal. You have stocks like Raytheon, which went down 15% in just one day. And I'm trying to do these short earnings review videos and try to assess if these kind of stocks are actually a buying opportunities on those dips, or if maybe the stock is still overpriced despite it coming down. And I believe Chipotle is actually a pretty interesting opportunity. The company is pretty amazing, and I'm gonna talk about it a little bit more in this video. Now, looking at their latest earnings, they actually did beat on EPS. I mean, I don't see why it went down 10%. I think it was a massive overreaction, but the stock is also up 50% on the year. So any kind of miss or disappointment is gonna go down because it was priced to perfection. So it came down 10% in just one day. But in terms of EPS per share, they beat the estimate. It was 1265 adjusted versus 1231. They did miss on revenue. I mean, nothing crazy. 2.51 instead of 2.53, nothing too crazy, but they also missed on comp sales, and this is something that the market freak out around a lot of the retailers, a lot of the restaurant stocks whenever they miss on same store sales, and they grew 7.4%, but they estimated 7.5%. I mean, it's no big deal, and the market is just short-term oriented, and whenever something misses, I mean, it just goes down 5 or 10%, and this normally tends to create a lot of opportunities. Now, the beautiful thing about Chipotle is, yes, it's big. Most of you know it in the United States with the foods that they have, but the company is still growing despite it being so massive, and they opened over 47 locations in this quarter alone. They're going to open over 230 locations in this year alone, and they're also expanding in the Middle East. They have some kind of a agreement with some kind of company over there to open up restaurants and franchises in Dubai and in Kuwait and a lot of those regions in the Middle East. And from my own research, I see that this is a new market for this kind of food that Chipotle actually makes. So it's going to be pretty interesting. And the company is still growing. It's still firing on all cylinders, despite it being, as big as you might believe it actually is. In terms of the income statement itself, I mean, the best thing I've seen pretty much is actually the labor cost. I was expecting much higher labor cost. It was 24.8% of sales, and in this quarter it was 24.3%. So I'm very impressed with how Chipotle held the labor cost. I mean, it's pretty good. I believe they raised a lot of prices. This is how they offset the labor cost, because most of those retailers, a lot of them cannot actually raise prices. In a lot of restaurants, they cannot raise prices, and if you can't, then labor cost inflation is going to eat away your margins. But this is not the case with Chipotle. Chipotle was able to raise prices and still even grow in sales and keep their margins high. Their margins actually expanded. If you look at the net income margin, it was 11.7% last year, and in this quarter is at a record 13.6%. Net income margin. Pretty amazing. I mean, the company is doing everything you pretty much want. But if we look at the PE ratio of Chipotle, now it's sitting around 42 times forward earnings. And 42 times forward earnings, as we can see, is pretty close to the historical average. The historical average has been somewhere around 43 times earnings, and now sitting at 42 times earnings. So it's pretty much at fair value on just this chart alone. It's close to the historical average. And 42 times earnings might seem extremely expensive for a restaurant or for a fast food kind of chain like Chipotle, but you have to take a lot of things into consideration. The first one is the growth, and the company has been growing 16% for a long time, and it's going to continue growing very rapidly for a long time, in my opinion. But you also have to look at something like the gross profit margins. They have record profit margins in terms of gross profit margins in the industry that's very, very competitive, and it's not easy to have higher margins. And Chipotle's margins have expanded from 29% in 2016 to 39%, almost 40% gross profit margins in 2023. And this is something that you have to factor in whenever you're looking at a high PE ratio. Something else that you have to look at is normally the return on capital. And in the case of Chipotle, it used to be around 20%. It took a big dive in 2019 and 2020, but it's been recovering. And as of 2022, it was around 19%. So all of that for a 40 PE ratio, it's not the best deal in the world, but it's not as expensive as most of you actually believe. Now, looking at my own valuation model, I used 14% revenue growth from 2023 to 2027. Now, I personally believe this is fair. This is what Chipotle was, growing before, and this is what the analysts estimate. So I think this is pretty fair. Net income margin is 13% right now. I kept it at 13%. PE ratio is now 42 times. I put it at 40 times in case of some multiple contraction, but 40 times or 42 times has been historically around the historical average, 38 to 40 times, which I believe is very fair, estimate for the future in terms of Chipotle's valuation. Chipotle doesn't pay a dividend and they don't do any major buybacks. Sometimes they do them, but over the past 2 to 3 years, they haven't bought back anything pretty much of the market cap. So the total return from today's prices is around 66% or 10.7% compounded every single year for the next 5 years. Now, this is actually not bad at all for a high quality company like Chipotle. But if I want to double my money with the stock, I would have to buy it around $1,566 per share. And $1,500 is actually, what it was trading at in February of 2023. But the stock is up over 50% this year. So if Chipotle ever gets to 1,500 or below, I personally believe it could be an amazing buying opportunity. I'm personally not buying it here. I think with such valuation and such growth, I can buy Visa, which is growing 10%. It has 50% net income margin and is trading at 27 times earnings. So for me, Chipotle, for my own taste, is a little bit expensive at those prices. I actually own a micro cap company in the UK that's trying to replicate whatever Chipotle is doing, and it's been pretty successful. I own it in my portfolio and I share everything in my investment group, in the link in the description if you're interested. But I personally believe it's not bad at such prices, but if Chipotle gets to $1,500 per share or below, I personally believe it could be an amazing buying opportunity, to open a position, and dollar cost average down from around $1,500 per share. This was no financial advice, of course. Thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.